everything on Wall Street that currently is recorded in like spreadsheets and like paper contracts and like horrible legacy systems, all of those things, like all the wealth in the world will eventually be tokens on blockchains.
All right, cool. We're live. Robert, how you doing, man?
I'm doing great. Excited to talk on Accelerate about all the things.
Awesome. Thanks for coming on. If you are in crypto, if you've been in crypto, you obviously know who Robert is. But let's assume you're a founder that is new, especially in this new cycle. I want to kind of go through your origin story, right? So you currently run Superstate, but before that, you were first known for running Compound. So can you just quickly explain, first of all, what Compound is, how you even came up with the idea for that company?
Yeah. So Compound is what we now call a DeFi protocol. When I first started working on it, it was before the phrase DeFi existed. But what Compound is a computer program running on a few different blockchains, but originally the Ethereum blockchain. And what it does is it allows people to earn an interest rate on crypto tokens or borrow crypto tokens from a protocol. And some of the first iterations of a borrow and lending marketplace, were thought of as peer-to-peer, where I would borrow a token from Mert, and hope that he would pay it back. Or I would borrow a token from Mert and he would give me another token as collateral. And we would hope to pay each other back. What Compound did is it took that premise and instead of a user interacting with another user, they interact with a pool. And this pool bundles everyone's assets together. And so it changed the experience of borrowing or lending, a token from, a multiplayer game to essentially a one-player game where it was always on and you could just choose to start earning interest or choose to borrow. And there was something always on the other side that allowed that transaction to take effect. And, at the peak, Compound had about 20 plus billion dollars of assets in it. Right now it's a couple billion, so it's still running quite strong. And, it was originally launched in 2018, which at this point is 7 years ago.
Right. And it's certainly a very, it sounds today, if you were to look back, it's like, okay, obviously there's a borrow and lend protocol, but of course at that time, this stuff was super new. And you said, the term DeFi hadn't even been formed yet. How did you just get into, I guess, like there's a few dimensions to this, but how did you get into Ethereum? And then how did you think, okay, we need to set up this pool concept to help people borrow and lend? Like, what was the origin?
Yeah, I'll give you the whole origin story of me getting the crypto in the first place and how it led to Compound. So I first became aware of crypto in 2012, 2013. I had a company that was building privacy software, and there's a lot of our customers were vaguely adjacently involved in crypto. And they would talk about Bitcoin, here and there. And I said, well, that's interesting. I'm going to try to mine Bitcoin. I'm not like an electrical engineer. I was not that successful at mining Bitcoin or that profitable. But, I mined a Bitcoin or two and probably sold it and made $15, right? And I said, oh, crypto's interesting. But I sort of put that aside for years. And then, I read the Ethereum white paper, a few years later, and I said to myself, wow, this is really cool. It's not going to happen. It's too complicated. I understand Bitcoin. I've read the white paper. Man, Bitcoin is complex. There's no way you can build, a general computing platform that enables smart contracts to run and everyone to interact with it. And it's, secure. It's too complicated. I don't think Ethereum will ever work or ship. And I was surprised when I didn't even know, I didn't participate in the ICO. I didn't watch the launch of it and Homestead and all this stuff. But I remember reading on Bloomberg that the DAO had blown up. And I said, wait, there's a DAO? There's smart contracts and they work. And there's hundreds of millions of dollars involved. I said, this is incredible. I have to pay attention to this. And so it was actually the DAO blowing up, which is when Ethereum forked into Ethereum and Ethereum Classic, that I really started paying attention to it and observing it. I didn't get involved. I didn't buy a single ether. I didn't write a single line of Solidity. I didn't learn Solidity until, late 2016. I started watching like ICOs start happening on Ethereum. And I said, okay, this is interesting. Like people are using the blockchain for new things. They're using it for crowdfunding. That's sort of interesting. In early 2017, I said, like, okay, I'm going to buy like, 10 ether and like play around with some smart contracts. Like I want to like, get my hands dirty. And the earliest things that we would call DeFi at the time were like starting to work around them. There was like a program called Token Trader. I think of this as the first DEX, Token Trader, for the crypto historians, look it up, find the GitHubs for it. Was relatively cool. And it was like a way for you to trade in a trustless and decentralized way. And, I learned a little bit of Solidity by forking it, redeploying it, making some edits to it. And I got really excited by it. Ether Delta, very quickly grew on the scene. I think Ether Delta is the second major successful like DeFi application in my mind. Um, Unbelievable computer program for when it launched. But it basically was like, essentially a club order book with a web interface built on top of the Ethereum blockchain. And you could, make orders and you could take orders and the whole thing worked. Like it was incredible. Um, and from that point on, like early 2017, I said, like, okay, I want to work in this. Like, I want to spend a lot of time, building an Ethereum. It was really the only platform at the time that would let you build something new with smart contracts. And when I looked around, like, there was not that many projects and that many teams putting Solidity to work or like trying something genuinely new. There was a lot of ICOs that were like ramping up. Like every week, there was starting to be more people like doing an ICO, but the actual code itself was never interesting. Um, Almost every ICO contract pretty much looked the same. Like they made a token and then they made a crowd sale contract, like sometimes with like slight differences of like, oh, it's locked for this amount of time, or like, oh, but like they were all pretty much the exact same contracts. There was very little experimentation happening. And so I sort of reverse engineered the problem at hand. I said, what's the coolest thing I can try to build with Solidity that doesn't exist yet? Like, what are people going to want at some point that maybe they don't even want right now, but they're going to want? And can I build it? Is it even possible? Like, do I have the knowledge? Does like society have the knowledge? Like, can we even pull this off? And where I went from there was like, I actually want to build a system for people to borrow and lend crypto. Right at this point, when there was a new ICO, they weren't being listed on exchanges that quickly. You couldn't short them. Like there was no derivatives markets yet. There was no perps for like, ICO coins. So I said like the prices are unjustifiably high because you can't borrow and short something. So like, why not make a system that lets you borrow an ICO token so that you can sell it? And, it required a lot of work at the time. Like, there weren't any like good libraries for Solidity. Like you had to basically build everything from scratch. I put a team together. A co-founder I'd worked with in my prior two companies, Jeff Hayes, he became my co-founder at Compound, and we got to work. We started from nothing, like zero knowledge of Solidity from an academic sense, trying to learn as much as we could about the language, its limitations, its like the powers that it had to try to put together a relatively complex system. And during that process, a lot of things evolved. Like a great example of this is, we ran into computational limits very early on. Where like the first versions of Compound in like the design sense, were like, from just like how we recorded like state, were extremely inefficient. We first started off saying like, oh, every user will write its data and then we'll like update the balances of every single user as interest occurs and transactions occur. And like none of this was really computationally scalable. So what we had to do was invent very basic, we'll call it like computational financial primitives for a smart contract to be able to calculate balances for an infinite number of users very easily. So a great example of this is like we use these things called interest rate indices, where we could basically increment an index that would apply to all users in parallel and their balances. So like every single user would earn the same interest rate because they would all be like taking their unique balance multiplied by an index, and then it would be able to be computed across all different users. And so we really just had to start from like nothing and like build like very basic, you know, programming building blocks for our own use. And eventually, about a year ish later, it led to the first version of Compound, which launched, I believe it was like August 2018. And that's how it all got started.
Very cool. What I'm interested in here is it seems like so you got interested in maybe the tech side of it, or maybe the possibilities of what you can just do with crypto. And I want to touch on that a bit later as well. But it seemed like it was almost like a tech project, like a hobby side project type of thing. When did you? Because like looking, obviously I've started Helios as well. Starting a company is somewhat of an insane endeavor in some regards. Maybe it doesn't seem like it when you first start. Uh, but like, why did you think that it should be a company? Like, what gave you that conviction?
Yeah, it's funny because at the time, the way everyone was structuring crypto native projects was basically this like ICO token sale SAFT fundraising model where like you had a bunch of people, they formed a company, they went out to investors, they raised SAFTs, SAFT, they don't really exist anymore, for those listening. But back in 2017, they were like all the rage, even going into 2018. And they were basically selling tokens before the token was created and invented, using the capital to hire people, to hire, everything needed to get it off the ground. Then they deploy the token, oftentimes before a project even existed. Like there was no protocol, there was no application. They just made the token and started trading. And then eventually they built the thing. So this was like the backdrop at the time. We made a couple of really interesting choices, where we said, we know it's going to take more than two people, me and my co-founder, to be able to build you know, a protocol, right? Like we know it's going to take, it's funny because like when we launched the first version, it might have been like 6 or 7 people, but we knew it was more than two. So we knew we had to raise money. And so, because everybody on earth was like doing these ICOs, we're like, okay, well, like we'll go out and raise capital from friends and family and tell them that like one day there like will probably be a token because every crypto project has a token. And you know, cobbled together, it was not even a lot of money. It might have been like $400,000 at the time, enough for like 5 people or so to like live off of ramen noodles in San Francisco.
Mm.
And, we said, okay, well, like this will hopefully be enough to like get us to the point of having a viable, like working example of this product. And then either we'll raise more money, hire more people, or we'll figure it out. And you know, it got us to the point of having a prototype, what we call V0. V0 of Compound was never deployed onto a blockchain. V0 of Compound was basically an end-to-end working proof of concept of what we now call a DeFi protocol, from the solidity to the web interface on top and everything in between, from like doing transaction logs and like processing them to like a small amount of storage off chain for like, making a user interface experience work really well. We basically built a V0 of, what at the time people called dApps. That term is not really used much anymore. DAPP, decentralized
Mhm.
app. I mean, some people use it still, but we basically built a fully working end-to-end dApp. Was it audited? No. Was it secure? Probably not. Was it efficient? No. But it proved to ourselves that this would work, that like you could actually make a system that did what we thought it was going to do. And we took that like working proof of concept, and then my co-founder and I, we went up and down Sand Hill Road in California, like pitching every venture capital firm. Long before there was a lot of like dedicated crypto VCs, like
Mhm.
we went and like pitched all these like boomer traditional venture firms, and we were like, look, we've like built a crypto system to borrow and lend crypto, like without having to trust us or trust a intermediary. Like it works. Like you don't have to do this on an exchange. You can do it on the blockchain. Like check this out. This is so cool. And at that point, Bain Capital, Polychain, and Andreessen Horowitz said like, okay, we'd like to invest in this. Like this is exciting. We'll give you the capital you need to hire as many people as you want. Like take this to production. And then about 6 months later, from that point, we started rebuilding everything from scratch with all of the knowledge that we had learned about Solidity, about how to build like an end-to-end system. And we got to work building V1, which was, the first like production version of Compound. Um, you know, spoiler, like, a few months after launch, we discovered a critical bug in version 1 of Compound. And at the time, we deployed this as something that wasn't upgradable. A lot of the
Mm.
crypto philosophy, in the early, smart contract days was that like contracts shouldn't be upgradable, period. There should be no governance. There should be no upgradability. You shouldn't be able to change the code. Like once you deploy it, that should be it. And so the first version of Compound was deployed as something with no upgradability. The code was the code. There was like a couple parameters that like an admin could set, like what's the maximum bound for an interest rate? What's the lower bound? Like really basic stuff. But the code itself couldn't change. And so when we discovered a bug in Compound V1, we said, well, we have to shut it down. Like, we can't patch it. Like we designed it so it couldn't be patched. And again, everything was an experiment back in those days. But we were able to launch a Compound V1, which got shut down a few months later.
So I do want to get to the continuation of that as well. One thing I'm curious on is, so this is, I guess, 2018 is when you started raising. How did you pitch, let's say, the future, the vision of the company, right? Because at that point, and really until I would say a few years ago, really borrow and lending was constrained to crypto assets, which would mean like, with the exception of like ETH, the base asset, it's like these tokens are kind of just like made up out of thin air. And that was like a big criticism. It's like, what is this economy like producing? How did you like pitch it? What did you envision it could evolve into?
Well, it's funny because, when I tell the story of Superstate now and, people ask me why I started it, it goes all the way back to what I pitched, these venture capital firms in like the beginning of 2018, which was, at the time I said, hey, there's all of these ICOs happening. There's all of these new tokens. Like every crypto project has its own token. Most of them were deployed like 6 weeks ago. There's going to continue to be all these crypto tokens. And we're building a system that lets you borrow and lend crypto tokens. But like what I told every venture capital firm at the time, it was like, this is the short term. Like, yes, all of these look like ICOs today, but eventually the crypto tokens that are going to be on Ethereum, and this is before Solana, but like will be on Solana, will be on every blockchain, right? The crypto tokens on these blockchains aren't going to be ICO tokens. They're going to be stocks and bonds and currencies and commodities and real estate and like everything you could possibly imagine. Like everything on Wall Street that currently is recorded in like spreadsheets and like paper contracts and like horrible legacy systems, all of those things, like all the wealth in the world will eventually be tokens on blockchains. And that by building Compound, starting for ICO coins, right? What we're really doing is we're building this protocol and this marketplace for Wall Street. No one knows that yet. And 2018 went by, it was mostly just ICO tokens. 2019 went by, pretty much the same thing. 2020 went by, pretty much the same thing. They weren't called ICOs then. They were like, protocols distributing tokens to users in a different way. 2021, same thing. Still no securities, no stocks, no bonds, no real estate. By this point, stable coins were big. And so like you could say like, currencies, check that one off. Like we sort of do have like tokenized currencies now. Like, but by 2023, which is when I left Compound to found Superstate, we still had like almost nothing new when it came to like the types of assets on chain that you could put inside a DeFi protocol, that you could program, that you could like, put to work or do something new with. And so to me as a DeFi founder, this was like unbelievably frustrating. Like, I thought the upper bound for what a DeFi protocol could be is like all the assets on Wall Street can go inside a DeFi protocol. But like from 2018 to 2023 and even to now, the total TVL hasn't really changed that much because it's kind of just this like closed ecosystem of all the tokens that people have created native to blockchains. And so as a DeFi founder, this is like the saddest and most disappointing thing is that like the upper bound, the ceiling for DeFi wasn't going up that much to what its potential is. Its potential is honestly $800 trillion, right? But right now the upper bound of DeFi is a lot smaller. So for me, it became my new mission to say like, okay, well, now that I know how DeFi works, and now that I've like had the experience building it, how can I start to like pull assets from Wall Street, and like traditional financial markets on chain so that they can go into DeFi protocols and so that like the ceiling of DeFi can go up and up and up.
Very interesting. I didn't know that. Um, and I guess, and I'm going to get to Superstate just shortly, but before that, because in 2018, I mean, I was kind of in crypto, but certainly not as involved as you. Um, what gave you the conviction that these serious assets, let's call them, would actually ever come on chain, and the regulation would ever clear up?
Yeah, I mean, what's funny is like in 2018, I think people were a lot more bullish about regulation than we'll call it in like the Gensler era of like
Mm.
2021 to the beginning of 2025, right? In 2018, from like a regulatory perspective, like it was a pretty like innovation friendly environment. Clayton and the SEC were cracking down on ICOs, which frankly, like a lot of them were quite bad, like for investors, quite
Mhm.
poorly like run, questionable ethics abounded, right? Like some of them like deserve to get cracked down on, but like for the most part, it was hands off. For the most part, it was like a pretty pro innovation stance of like, hey, like let people build new systems. And if they violate society's like rules or expectations or trust in some way, yeah, like crack down on it. But like if not, like let people build new things was kind of the vibe that I felt that a lot of people felt. I mean, like, founders were leaving, Wall Street and other tech companies in droves to start building things. And, maybe it was overly optimistic, or whatever, but like I felt it. Like I felt that, because blockchains are just a superior environment to record the ownership of assets, then eventually all the assets would come over. And the reason I believe this so like core to my being is, I worked at a bank in 2007 when the financial crisis hit. And I got to see like up close and personal that there's real crazy problems that occur when every single bank has a different view of the state of the world than all of their trading counterparties do. Like no bank knew the health of any of the other banks that they were trading with or interacting with
Mm.
because everyone's balance sheet was opaque and internal. Like even something as simple as like a swap or a derivative that like, let's say I was a bank and Mert's a bank, if we have a derivative transaction between each other, we might disagree on who owes who money and how much money based on a whole host of reasons, right? There's no consensus understanding of the state of the world or the state of an asset or the state of a balance sheet or the state of financial transactions. Everyone had their own ledger and everyone disagreed with everyone else over what was on those ledgers. And so
Mm.
when 2007, 2008, 2009, the financial crisis was in full swing, no one really trusted each other. And like no one like could really do business with each other. Like LIBOR and like interbank lending rates went, crazy, everything broke. And like you had all of these problems originating from the fact that there was like 100 different ledgers, right?
Mhm.
Whereas if there was one ledger, right, and it was transparent, then like most of these problems could be avoided. You know, if you know, if you didn't have to guess. And so for me, coming from that experience, I said to myself, like, well, okay, like financial assets will live on a blockchain where there's no disputing who owns it, how much is there, how does it work, and what's the entire history of the asset. Like, there's no questions. Like, it allows finance and economics just to function at just a much more fundamentally efficient level. Coupled with the fact that crypto transactions are basically instant, basically free, basically final, and global, right? So it's like it's just such a better environment for financial assets to exist than the historical alternative.
Right. Okay. So, yeah, I mean, obviously, I would agree with that, but that is, it's like maybe as a mental model, it's like, okay, this is kind of a much better system. It's how it probably should be in the end game, and so how do we get there? And so, so you were at Compound, and then like was the main reason that you then started Superstate the problem that you described, which is like, okay, I'm just annoyed that these assets aren't Wall Street assets. They're not like the things that we thought we would already have by now.
That's exactly right. And like, listen, I love crypto native assets. I think there will always be crypto native assets, things that like start off on the blockchain for the blockchain investors and for the blockchain users. Like, crypto native assets are great, but it's a small fraction of the total assets that could be on chain. And so it was really just born of frustration, seeing more and more crypto native assets, which are good and should be there, but seeing zero growth in the non-crypto native assets. And I figured if anyone can do this, I would have a good chance at being able to start to tokenize off-chain things, bring them on chain.
And walk us through. So it's 2023. You've left Compound. You're going to start Superstate. Was it? I mean, I'm guessing some of this is more clear in hindsight, but at that time, how foggy was it? Like, did you know exactly what you wanted to take on chain, how the company would look, et cetera?
It's funny because, when I first started Compound, I said, okay, I want to go about this tokenizing asset thing. Our first idea for this was to say, like, okay, what's the right way to tokenize an asset, right? And, in our mind, it was, well, you have to partner with the original issuer of the asset, right? If it's, a stock, you have to work with the company that issued the stock. If it's a bond, you have to work with the company that issued the bond. If it's a private fund, you got to work with the issuer of the private fund, right? If it's a public fund, like an ETF, you got to work with the issuer of the ETF. We thought that this would be like the correct approach. And there's a lot of alternative approaches that we thought of, 2 years ago as well, being like, well, maybe there's alternatives. Maybe you just buy the thing, put it into a wrapper, and then tokenize the wrapper. But we decided very early on, based on our designs, that like the right approach that we wanted to take was working with, the original issuer of an asset as their sort of like, well, their agent, so to speak, to like tokenize their stock or their bond or their fund. And we knew at the time that like it was going to be really hard to convince issuers of financial assets to trust us. Even though I'd like built a DeFi protocol and I loved the space and all these things, we thought it was going to be hard to convince, in some cases, like, whether it's a public company or like an asset manager, convince them to try something entirely new. And so the approach we took was to stand this up, by one, starting to build out all the technology of like, how does tokenization work? How does the record keeping work? How does like, the backend systems work? How do we index, the blockchains? How do we like monitor the transactions? Like the whole backend. But in parallel, we said, well, we're going to be the issuer of the first assets. We're going to, register as an investment advisor, and we're going to spin up our own products to have something to test and to prove out, our approach to tokenization, and that it works, and that it's scalable, and that we can do it for other issuers. And so the way we started was with a tokenized T-bill fund that we were the asset manager of, and a tokenized, crypto interest rate derived fund. It's a cash and carry fund that we're the investment manager of. We basically, like for our first two products, we're both the issuer and the tokenization platform, really to get this off the ground, prove out the model. And now we're at the point where we know it works. We've processed billions of dollars of transactions. The whole system is, incredible. Like the investor portals are incredible. The experience all around just works, and it's phenomenal. And we're now at the point where like issuers will trust us to tokenize their assets. And so, we're at the point now where we can expand from being the issuer and the tokenization platform to really being just the tokenization platform. And from here, we're going into public equities. When a company registers its stocks, that people can own it, we partner with that issuer through a product that we're calling Opening Bell for their stock to start trading on a blockchain. So a company could be listed on the NASDAQ and on Solana. And, we think this is a phenomenal, experience for issuers. The first issuers will probably be going live in the very near future. Announcements TBD, but it's a really interesting approach that we've taken to like, how do we like measure and stagger the launch of different product characteristics?
Got it. Okay, so Opening Bell, you'll basically be able to, and it doesn't matter if you're a crypto company or a regular type of company, you're basically doing an IPO, but one of the trading venues can also be a blockchain, like, for example, Solana. Is that right?
Exactly.
Okay. And that's interesting because like you started with ICOs and then now you're basically like legitimize them. Yeah, exactly. How does that process work, right? Because like I think a few I guess this is more of a artifact of Gensler, but people used to say things like, "Oh, like you'll never get stocks on blockchains. That those are securities, and securities are all like crime and all this stuff." But obviously, what was the problem was that they were unregistered, and like people just were not adhering to regulations. So, like, how do you or maybe before I get to that question, what would be the incentive, or like what are the companies getting out of this when they get to go public on a blockchain as well?
Yeah. So what the companies get out of this is a totally different and supplemental investor base to what they already have, right? So if you imagine a company, I won't name a specific company that's, in crypto, so I'll just say Apple, right? If Apple were to tokenize their stock and it was traded, on a blockchain, and they're a canonical stock, like Apple, the company is like putting the tokenized Apple stock on a blockchain, everyone will be comfortable knowing that it's Apple, knowing that there's no quirks to it, knowing that there's no gotchas to it. I think there's a differentiated investor base. There's people that have, stable coins, or that have, crypto tokens that, will buy Apple stock that otherwise wouldn't have, where they're like, I want to keep my money in crypto. I want my money to be in my Solana wallet so that the second I want to trade it for some new meme coin is one click. And like, I don't have to move money between a brokerage account and like, my wallet, and it takes all this time and it's horrible. I think there's incremental demand and there's incremental buyers than there otherwise are. There's also incremental demand from, you know, the fact that, over time, I think institutions will prefer the tokenized form of a security over the TradFi form, because the TradFi form sucks. Like, it settles like at best T+1. It's really hard to move. It's, it doesn't like integrate with the same custodians that a crypto native firm might use. It doesn't integrate with the same systems. So I think eventually you're going to start to see like institutions just preferring the tokenized form factor of stocks over their, traditional counterparts. And so, I think there's just going to be net more demand for stock when it's tokenized. I think it's just incremental. Is it a massive incremental amount of demand? TBD. But it's definitely non-zero and it's definitely incremental. By tokenizing your stock, you can't have less demand. You can only have more. And so, the primary thing that people get is just demand for their stock. And for every company, you know,
Mhm.
the cost of capital and the demand for their stock is the sort of lifeblood of the long-term health of being a public company. And so, it's healthy for companies that choose to do it. And, you know, we haven't really seen examples of this going live significantly yet. The first tokenized stock, Exodus, has been around for a couple of years, but it's been, pretty much, quiet and under the radar. Um, I think as we start to see more examples of tokenized stocks on Solana and on Ethereum, we're going to start to see like the exact data around companies and like what they're getting out of it and how many new investors they have and how much trading volume there is and the market for tokenized stock.
Got it. And walk me through the mechanics of this. Would you issue the stock and it would be tradable on both something like a NYSE and like a Solana, or would it be just one of them and then you would graduate to the other or something?
Yeah, every permutation is possible. What we're doing is we're starting with companies that are already publicly traded on, let's say, the NASDAQ or NYSE,
Mhm.
that want to additionally list on a blockchain like Solana. And so, right now they're already registered. They've done the hard work of registering their stocks so that anyone can own it. They already do all the financial filings. They already do all of that stuff. It's essentially like an update to their disclosures. Let's say like an 8K update saying, now we plan to tokenize our stock. It will be traded on a blockchain. There's a couple additional risks that you might not have versus stock traded on the NASDAQ. But, you know, we're planning to list our stock on a blockchain. And here's what to expect. We're working with Superstate as our transfer agent. From there, it can start trading on a blockchain. Whether it's peer to peer or through an exchange, there's some light regulatory work that's still being handled, sort of behind the scenes. But I expect that at some point soon you're going to have trading, you know, bilaterally. You're going to have trading through RFQs. You're going to have trading in AMMs. You're going to have trading in clubs. You're going to have all of these different things, and the stock starts trading. on chain as well. And so, if you're an issuer, you've already done the hard work. Really, it's just a matter of choosing to tokenize your stock and allowing it to trade in new venues as well. And
So,
it doesn't have to
mhm,
be that way. Like there could be issuers that debut simultaneously on the NASDAQ
mhm,
and on a blockchain. They might say like, oh, when we first go live, we want to go live everywhere. And you
mhm,
might have issuers that choose to go live first on a blockchain and then graduate or uplist to like the New York Stock Exchange.
mhm, mhm. So there's some, let's say, a new buzz in terms of stocks on chain, and I believe, I mean, Robinhood is going to do them, and then there's X stock, and it seems like the difference is that those are mirror assets in some sort. They're synthetics, versus this would be actually native from those issuers. Is that the
That's
big
completely
difference there?
correct. Yeah, that's completely correct. This would be the native asset being tokenized versus a mirror asset. So the best example I use when I think about this in my own head is that there's native USDC on a number of different blockchains. There's also
Mhm.
bridged USDC on a lot of different blockchains. And like the bridged asset is different than the native asset. And like when you
Right.
look at it, there's like so many different USDCs. Like when I look at like, a different blockchain, like some blockchains, and the problem is worse on other blockchains versus others, but like some blockchains have like way too many versions of like something as simple as like bridged USDC. There might be like 5 versions bridged from
Right.
there. It's like, and they're all fundamentally different assets. They all behave basically the same and they're all worth roughly $1, but they're all different. And there's like a lot of complexity based on how many versions there are. If you go on CoinGecko and just type the letters ETH, it's like there's like 400 different ethers, like different wrappers around it, different versions of it, different staking structures behind it. There's like 400 ethers that you might be referring to versus the canonical one. And so our hope is that, by focusing just on the canonical one, you know, it is differentiated from all the different wrappers. And you can do cool things with wrappers. Like some wrappers might come up with really interesting mechanics, but like the native thing is cool because it's the actual stock. If the company
Mhm.
wanted to pay an in-kind crypto dividend, it could, because it knows that all the people holding its tokens are the actual shareholders of the company. And so they could do really cool things like, pay a sole dividend directly to the wallets of everyone who holds the
Mhm.
stock on Solana. Like you could do really new and novel and interesting things. You could airdrop stock directly into the shareholders' wallets. You
Mhm.
could allow people to vote at your, annual meeting, directly with their crypto wallets. Like there's a lot of interesting things you can do when the tokens are the shares. And I think it gives like issuers a couple advantages over, some third party who comes up with a structure to like buy the shares and put them into a new vehicle and like issue tokens against it. And things that are like managed by a third party versus managed by the company themselves.
Yeah, that's really cool. When I made a post on X stocks, that was one of the biggest, let's say, things that people replied with is like, okay, are these actually backed? Do I actually get such and such rights? One thing that I'm curious, maybe a niche concern or just a question, is like the traditional stocks. You need to like be you need to do like some KYC on an exchange and whatnot, and then you can finally trade them. If these will be like available on AMMs in some future, how does that really work? Like,
Great question.
how can that? Yeah.
Yeah. So our model is that the token is the actual share of the company. And in order for someone to be able to hold it, when someone holds it, they are the registered shareholder. It's like their name is on the company's books and records. It's like, oh, Mert owns 200 of our shares. Like, he can vote at our meeting. He can get the dividend. He can do all these things. The way we do that is by knowing who each of the shareholders are. And so we basically have the concept of an allow list, which just means, we have off chain, held at an SEC registered transfer agent, a mapping of, investor and their wallet address. And we know as the transfer agent who you are, right? Um, the blockchain doesn't list out everyone's name tied to their address. It's not like overly, you know, information leaking, but we have to know so that the company can know who owns their stock. And there's a few ways that we're, going to be populating this allow list. One is, people can sign up on Superstate. onboard to us, give us that information, say these are my wallets, and then, once you've done that, you can hold any stock that we tokenize, right? But we're also, expecting to partner with a few different wallet providers as well. And so wallet providers that roll out KYC, that's opt in, people might be able to say like, okay, you know what, like it would be cool to trade, actual securities, legally and compliantly on a blockchain. Like, yeah, I'll give you my information, a limited amount of information, so that the company knows who I am.
Mhm.
And partner with wallet providers so they can populate this concept of an allow list as well. And the end result is that, you know, as long as you're willing to disclose who you are, you can own these shares. There's always going to be versions of this stuff that like doesn't require that, and that's cool. I mean, that's the free market, right? Like, I think
Mhm.
there's a place for both, right? Um, but our approach is to basically say like, yeah, join this allow list, whether through Superstate or through a partner, and then you can hold tokenized stocks. You can have fun with them. You can trade them. The on-chain contracts only allow them to go into your wallet if you're on the allow list. Like, a transaction will fail if you're like, buy it on the AMM, if you're not capable of holding it. And in this way, it's like we sort of like meet all the standards of compliance that like companies need, regulators need, and is hopefully a light enough burden that, you know, people don't mind going through it once and being able to trade stocks forever.
Very cool. Very cool. I do want to get to the types of assets that might start with it. I think there's like a very obvious candidate that's all the buzz right now. But I do want to ask kind of a silly question at first, because you started. I mean, you're obviously an Ethereum OG, and a few years ago, it would have been pretty, let's say, unheard of for an Ethereum OG, or Ethereum founder to actually expand into Solana, with really any product, but especially one that requires RWAs. What and obviously, like, this is going to be multi-chain, right? Like, I think Chain also does with Infinex, where it's like you expand to Solana, but it's multi-chain. I think most serious people do this. What like brought you? What convinced you that like Solana would be a good place to? I think like one of the first two launch places for this.
Yeah, objectively, I mean, the two largest user bases, in crypto for potential users and investors in these products are Ethereum and Solana, right? My goal is to take this wherever there's demand, wherever there's a large user base. If in like 10 years, some blockchain that hasn't been invented yet becomes like the number one blockchain, it's like issuers are going to want their stock to trade on that blockchain. But right now, when you talk to issuers, like, there's really only two places, right, that an issuer would say, I want my stock. It's either Ethereum or Solana, right? And so, there's a lot of reasons for that. The user bases are large, the wallet share is large, the amount of capital on chain is large, the amount of DeFi applications large, right? Like, these are the two most like ripe environments for RWAs. And so, you know, I'm not a tribalist. Like, at the end of the day, like, I know Ethereum best because I've spent the most amount of years building on Ethereum. I've had to
Mhm.
learn new things and the quirks of building on Solana, and there are quirks,
Mhm.
um, and challenges to it. But it's a challenge that I'm excited to take on, which is learning a new computing environment and building for it. And so, to me, it's a no-brainer to focus on the biggest markets. And eventually, yeah, like, we'll work our way down the list, over time. And tokenized stocks will be on a small blockchain, I hope, when Superstate has 900 engineers, But we're starting
Mhm.
with the biggest, and where I think there's the most users ready to trade these assets.
Mhm. So I want to get to, you mentioned like the first few, and I think some of this is public already anyways, would be like starting on like a NASDAQ or something, and then we would just bring them to the chain. And that basically makes me think of treasury companies, right? Which are kind of all the buzz right now. What do you think about the current state of treasury companies? Do you think, I mean, obviously, like there's certain things that you can say and cannot say, but like, just what do you think of the concept and maybe the longevity?
Yeah, so I'll start with the things I can say very openly. So at Superstate, we've announced two different companies that are planning to tokenize their stock and launch with Superstate, um, both of which are treasury companies and Solana treasury companies. These are a natural fit for tokenizing stock, right? There's more treasury companies that I can't name directly because they're public companies, and there's more
Mhm.
companies that are not treasury companies that are planning to tokenize their stock. But what all of these companies have in common is that they're operating in the crypto space. Their users slash investors slash customers are in crypto. And there's a really natural fit between what they do and wanting their stock to trade in crypto. We don't yet have like a Nike or an Apple or a Campbell soup or some like traditional business that's like tokenizing your stock. One day we will, right? Like guarantee you at some point, like random companies in the S&P 500 tokenize their stock using Superstate once they see the benefits of it. But they're all crypto companies, to start with. And to speak about like digital asset treasury companies specifically, I'm personally an investor in a couple of them. I think the model's really interesting. I think strategy slash micro strategy, as they've rebranded themselves, has really defined the category for a lot of people. In that, like, you can have a company that all they do is buy crypto, but they're good at it, and the company is worth more than the crypto it holds because they're so good at it, and they know how to finance it, and they know how to add value to it. And so you know, I think there's staying power because strategy has proven the model that there's staying power. Strategy is not a 2-month-old company. Strategy
Mhm.
is an old company at this point. They've been doing a Bitcoin treasury for a long time. And they've
Mhm.
proven out this model and it working over years and years and years and different market cycles. And so, there have been hard times for strategy, right? Like Michael Saylor has had times where he's been probably unhappy, off camera, right?
Mhm.
But the model has continued to work through cycles and continue to grow. And so I think, the core concept of a digital asset treasury company is sound. And I think strategy has proven out its soundness. I think it's possible that, there's supply and demand issues and that there's so many digital asset treasuries coming to market that there's not enough capital to be bid for it all from retail, from institutional investors, from whoever wants to invest in them. And that there's a temporary you know, imbalance, right? It's possible that part of strategy's success for so long is that they were the only one, right? And
Mm.
now we might at some point get into a situation where there's more supply than demand. I don't know. But I think the underlying model is sound. I think there's probably going to be turbulence at some point because the supply of them is increasing extremely rapidly. I think the biggest, most successful ones will probably thrive, not just survive through this. I think they'll like feast on the carcasses of the less successful digital asset treasury companies. And I think like in the aggregate, all of these things are just like a sinkhole for crypto. And that they're all just going to continue in the aggregate to grow over time. There'll be more and more Bitcoin locked up in treasury companies, more and more Ether, more and more Sol, more and more fill in the blank. And I think the model will continue to survive in perpetuity. Individual companies, who knows, right? But the biggest will for sure survive and probably eat up the smaller ones.
Got it. Yeah, that makes a lot of sense. I want to get to some tactical stuff and like advice for founders, DeFi founders, all that. I do want to touch on one final point around tokenization, though, which is we've also seen private companies. I mean, really, without their permission, it seems, issue or like private shares be on secondary markets through. I think like Robinhood, but also I think there's like a company called Republic doing it. Um, what do you think of that model?
I think that model's tough. And I think it's tough because doing anything with private companies is tough, frankly. All the rules, for public companies are complex. And there's a reason why public companies try to have such a strong control over who their shareholders are and how many shareholders they have. And this is because when a company has enough shareholders and it gets large enough, they're actually required to go public, right? And so you see companies staying private for a long amount of time. Like Stripe is still private, like years later. They have all sorts of like, strategies behind the scenes to like be able to stay private. And it mostly comes down to the fact that they have like such extreme control over their cap table. In general, tech companies stay private for a really long time nowadays. Crypto ones issue tokens and go quasi public a lot sooner. But companies love to have control over who their stockholders are because they like to control when they go public and when they start trading. They like to, you know, control their own destiny. They don't like it when third parties get to decide these things for them, right? So there will be private companies that love the idea of being tokenized. There will be. There will be private companies that hate the idea of being tokenized, like OpenAI, right? And there will be situations where companies say no to this. They say like, hey, that's sort of, against the rules, it's illegal or whatever. Um, and they'll crack down on it. There's going to be both. Like there will for sure be private companies that want some like threading the needle way of like being traded and there being a sort of market price, but the company itself not registering yet and going public yet. And so, you know, I think it's a lot more challenging than public companies. Public companies do the hard work of like getting audited financials, putting together like disclosures, filing the S1, doing all these things, and because they're ready. And for them, it's like, yeah, like more trading the better. Like go wild, like tokenize the stock, like do all these things. But private companies, it's so much more challenging because they don't want someone else to tip their hand.
Right. Right. Cool. Well, so you have obviously started two very impressive companies, and I mean, related companies, but I would say like on the order of difficulty, they seem to be very difficult types of companies
Very difficult.
involving, a lot of unsexy work. What would your advice be to, let's say, people interested in this space as founders? Like, how should they? What are some of the lessons you've learned that you think might be interesting for them to also take part?
Yeah, the first major lesson I've learned is actually on investors. And Superstate is actually my fourth company. So before Compound, I was the founder of two companies before that. So I've had
Hmm.
a few different at bats here. One of my major lessons is investors. Like Warren Buffett says, he would never do business with someone who he doesn't want to do business with and doesn't trust, no matter how good the opportunity is. Investment is the same way. Like once someone is on your cap table, they're kind of with you for life. Like it's basically impossible to get rid of them. And so, I don't think this gets talked about enough, but I think founders should be really picky about who they accept as investors. And there's times where you can't be picky. If you're like, oh my God, we need capital, we're going under, like, the market chooses for you. But if you have the good fortune of being able to choose who you're raising money from, don't work with anyone who you're not excited to have on your cap table or who you don't trust to be on your cap table because you can't get rid of them. I've had bad investor experiences where like, you know, some investors like, you know, do this now because I need to make an exit now. I need liquidity now. And it's like, come on, like no. It's like you want investors who are gonna let you, you know, build something successful over a long period of time. Like you don't want investors who are gonna like try to like steer the ship like for their own purposes. You don't need them like people who are going to be arguing with you like because they like to hear their own voice. You don't need people that are, unscrupulous and want to do like side business deals with you. Like choose investors that you think you can like work with really confidently for a decade. Because in a lot of cases, startups last a decade, Some of the longest companies stay private for an incredible amount of time. And so just assume that everyone you accept onto your cap table is going to be there forever. And you're going to have to answer their phone calls and you're going to have to call them. And so be picky if you can. Don't ever work with people you don't really want to work with. And if something weirds you out about an investor, like don't take their money. So that's the first major piece of advice I have. The second is like fail fast, right? This doesn't mean like shut down your company quickly, but it means like, you know, be willing to try stuff, be proven wrong. Like there's no ego in this. Like, Jeff Bezos has the greatest quote ever, which is, after the Fire Phone was a total disaster, a journalist was like, "Oh my God, are you embarrassed? Like the Fire Phone was a total disaster." He said, "Like embarrassed? Like God, I'm proud. Like that was a huge flop. Like if you're not having massive flops, it means you're not swinging hard enough. Like And so like truly get comfortable with failure. Like your idea won't work. That's okay. You know, like it's better for you to realize that after 2 months than it is 2 years. Because if you realize that after 2 months, it's just that much more time you have to try something that will work and to iterate it and to pivot it and to try something entirely new. And so, like, embrace things not working, learn from it, you know, like get back up to the plate and try something new as soon as you can.
Yeah, that's great advice. Especially the point on investors. I really don't think that's talked about nearly enough, especially in crypto. But
There's some bad people in crypto. Let me say that, especially in
yes,
crypto.
yes, absolutely. Well, you're also, I just remember, you're also an investor with Robot, right?
Yes.
Ventures as well. Um,
Yes.
and I imagine you've seen countless pitch decks and met a lot of founders that try to pitch you at all sorts of events. What would you say is like some of the most common mistakes that you think are like relatively avoidable?
Yeah, I mean, the most common mistake is being the 37th version of a project. Um, it's very easy to fall into a trap of basically copying something that's successful with like one little twist. If it's like, oh, we're going to do the same thing but for a new blockchain, or we're going to take something that we know works, like this AMM, and just deploy it somewhere else. We're going to do this other thing. It's like it's fine. Like if you're the first of something, the odds that you fail are really high, right? And so it's scary, but it'll genuinely be unique and like extremely differentiated. If you're the 37th of something and there's like a playbook by now, you know, there's probably like 20 other teams pitching the same investors, the exact same idea at the exact same time. And so I think it's very easy to fall into this trap of like, oh, this thing worked. So like we're just going to do that too with like a little bit of a differentiator without even realizing that like there's so many founders out there that want to do the same thing. It's like almost every idea I see like 40 times. It's very rare that I see an idea twice. It's like you see it like never once, twice, or like 40 times. You see it with digital asset treasury companies today. MicroStrategy
Mhm.
killed it, right? There's not like three of them now. There's like 190 of them now, like in just a short amount of
Mhm.
time. And so, ideas go viral. Try not to fall into this like idea virality, like, pack mentality where it's like, everyone's doing this thing now. Like, let's also do it. It's like, you know, like sit back, like, get a whiteboard, think of something kooky, think of something that's like actually weird or hasn't been done. Think about why it would work, why it wouldn't work. And like, as much uniqueness as you can add to a process, like try to add something unique because investors have seen it all. They haven't seen something unique.
Right. Yeah, I definitely plus one on that. I've probably seen 70 versions of meme coin launchpads at this point, or
Yeah.
some sort of like social trading app, which I mean, but I think that advice generally holds. Okay, final question. What is the worst piece of startup advice you received?
Oh man, that's a hard question because I mean, I've probably received like a lot of bad startup advice over the years. I've received a lot of good startup advice too. I would say the worst startup advice that I've received personally would probably be, earlier on in my career, like companies before Compound, even that, you know, the advice was to like scale before a company's ready to scale, right? When I was building Compound, that wasn't really an issue because, like, honestly, software, like a smart contract scales infinitely. Like, I didn't have to hire more people as like assets went from a million to 10 million to 100 million to a billion to 10 billion. Like, they scale beautifully. But like, I've previously received advice from investors that are well meaning and like well intentioned that are like, oh, like once you're starting to get revenue, you're starting to get traction, like go big, like hire way more people, like, put your pedal to the metal, like go, 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 go. And that works if you've caught lightning in a bottle. If you've caught lightning in a bottle, and it's like something new and you found an edge on the market, it's like, yeah, like 100x it. But your average company shouldn't 100x, right? Like if you're like going to go from a team of 5 to a team of like 30 too fast, like it's going to be a disaster. And I think startups get told often, like, okay, do more, scale, grow, like put the money to work. You just raised $7 million. Go spend $7 million. And
Mm.
I think it's like really just like a backwards thinking and a backwards approach. Because like from an investor's mindset, it's like, well, we want the company to like 10x or go to zero as like soon as possible. So we like know our IRR and like all these things. Like, investors can be well meaning, but it's not the right advice for the company in a lot of the cases. And so it's like, don't scale prematurely, right? It's like scale when you're ready. Scale when like in your gut, like that you have product market fit. Like scale when you know that like the economics of the thing are correct, and that there's no like catastrophic bugs or security risks, and that like you know what to do with more headcount once it joins your team, and like you know what people are doing. Like if you scale for the sake of scaling, like bad things happen.
Yeah, that is great advice. And with that, we'll end it there. Robert, thank you so much. This was great.
Right. Thanks for having me on the show.